Financial DNA. You're not crazy. Money. Some people have it, some don't. Some have figured it out, but most are still chasing it. We tend to see money as math, spreadsheets, numbers, and formulas. But real money decisions, they happen away from calculators, at the dinner table, influenced by pride, fear, ego, and personal history. Money is the intersection of logic and emotion, a mix of cold math and messy human behavior. Financial success isn't about how smart you are, it's about how you act. This video explores the emotional and deeply personal side of money. Our financial DNA. We all have different backgrounds, different generations, incomes, values, and upbringings, shaped by the times and environments we grew up in. Take inflation in the stock market. If you were born in 1970, the market boomed during your early years, likely giving you confidence in investing. If you were born in 1950, the market was flat in your youth, which might have made you skeptical. Born in the 60s, you probably remember the sting of high inflation. Born in the 90s, inflation probably didn't feel like a big deal at all. Your financial worldview is based on your lived experiences, passed down by your parents and shaped by the unique moments in your life. People do some crazy things with money, but no one is crazy. Our decisions make sense to us, given what we know and have been through. Compound King's Buffett's secret. Warren Buffett is one of the greatest investors of all time, but the real secret? Time. Most of his wealth, over $81 billion, came after he turned 65. Buffett didn't just invest well. He started young, at age 10. The power of compound interest over decades is what made him a billionaire many times over. If he had started later, say at 30, even with the same impressive returns, he would have been worth only about $12 million. Still rich, but nothing compared to $84 billion. Time matters more than timing. Many investors who achieved higher annual returns have less overall wealth simply because they started later. Compound interest rewards patience. Why we're drawn to pessimism. Optimism believes in long-term success despite short-term setbacks. But when it comes to money, we lean toward pessimism. Why? Because bad news is immediate and dramatic, while progress is slow and quiet. A 40% market drop grabs headlines. A 140% rise over 6 years, barely noticed. We notice tragedy, but overlook the steady positive trends. Remember, progress happens over time, even if it's hard to see. Stay optimistic. The long-term odds are in your favor. Two forgotten forces, luck and risk. In 1968, one school in Seattle, Lakeside, leased a computer. Only 300 students attended. One of them was Bill Gates. Without Lakeside, there may have been no Microsoft. That's luck. But there was also Kent Evans, a brilliant classmate of Gates who died in a climbing accident. That's risk. These two invisible forces shape all our lives. You can steer your ship, but the wind and waves, luck and risk, still have their say. The key to happiness. What do people really want from money? Freedom. Happiness isn't about luxury. It's about doing what you want, when you want, with whom you want, for as long as you want. Even as incomes rise, people often trade their time for more money, losing freedom in the process. The real dividend of money? Control over your time. Not wealth for its own sake, but for the autonomy it brings. Tail events, the hidden drivers of success. Investor Heinz Berggruen made a fortune through art, but not because every painting he bought was a masterpiece. Only a few became incredibly valuable. The rest? Not much. This is the concept of long tails, where a small percentage of outcomes drive most of the results. This applies to business too. Amazon's success was driven mainly by just two products, AWS and Prime. Most startups in venture capital fail, but a few winners make up for the rest. Comedians test hundreds of jokes. Only the best make it into the Netflix special. Success often depends on a handful of big wins, not consistent perfection. True wealth versus being rich. Rich people might have flashy cars, big houses, and luxury goods. But wealth is what you don't see. It's money saved and invested, not spent. Real wealth is invisible, and it comes from restraint, discipline, and the ability to say no to unnecessary spending. The key to building wealth? Spend less than you earn and don't flaunt it. The price of investing. Investing is like climbing a mountain. You expect risk, uncertainty, and setbacks. But with money, people want the reward without the discomfort. Trying to avoid market volatility is like trying to steal the car instead of buying it. It doesn't work in the long run. The real price of investing isn't money. It's the emotional toll, fear, uncertainty, and patience. Accept the fee, don't fight it, because it's the cost of long-term success. Hedonic treadmills, knowing when it's enough. Humans adapt quickly. You get something you wanted, and soon want more. Ultra-wealthy individuals like Bernie Madoff and Rajat Gupta still wanted more, and it led to their downfall. Not knowing when enough is a recipe for misery. True contentment comes from knowing your limits and not always chasing more. Thanks for watching. Don't forget to like, subscribe, and leave a comment below. I'd love to hear from you.